Ah, Budget Day. A day that resonates with excitement and anticipation across the nation. In India, it's not just about numbers. It's practically a festival. Families gather around their televisions, communities come together, and there's a palpable buzz in the air. The Finance Minister, our very own Dr. Nirmala Sitharaman, took center stage. With poise and confidence, she addressed the nation, knowing the weight of her words. She had a tough act to follow, mind you. The preparation is intense, the stakes are high, and the expectations even higher. Last year's budget was quite a showstopper. It set the bar high with its ambitious plans and bold announcements. But, as they say, the show must go on. Each year brings new challenges and opportunities. And this year's budget? Well, it had its own share of drama, surprises, and of course, a whole lot of numbers. From tax reforms to new policies, it was a roller coaster of emotions. Ready to dive in? Buckle up. The journey through the budget is always an enlightening experience. The Indian budget is more than just a financial statement. It's a blueprint for the country's future. It's a reflection of the government's vision for the nation. It outlines the priorities, the goals, and the roadmap for the coming year. It's about setting priorities, allocating resources, and charting a course for economic growth and development. Every number, every policy, every announcement has a story to tell. So, when the Finance Minister rises to present the budget, the nation listens with bated breath. It's a moment of unity, a moment of hope, and a moment of anticipation for what lies ahead. First things first, the size matters. This year we're talking a whopping 48.21 lakh crore rupees. That's a lot of zeros, folks. To put it simply, the government plans to spend more this year. Infrastructure, healthcare, education, you name it, there's probably some money allocated for it in this massive budget. Now, a bigger budget doesn't always mean better outcomes. It's all about how effectively this money is spent. Will it translate into tangible benefits for the common man? That's the million-dollar question, or should I say, the 48.21 lakh crore rupee question. Here's a bit of good news, maybe. The government plans to borrow less from the market this year. They're aiming for 14.01 lakh crore, which is lower than what many experts predicted. Now, borrowing less is generally seen as a positive sign. It suggests that the government is trying to manage its finances responsibly. But here's the catch. Borrowing less might also mean that the government has fewer funds available for public spending. And that could have implications for various sectors and programs. So while it's good news on the surface, the devil, as always, is in the details. Remember that whole fiscal deficit thing? It basically means how much more the government is spending than it's earning. This year, the government is aiming to bring it down to 4.9% of the GDP. In simpler words, they're trying to narrow the gap between income and expenditure. Now, a lower fiscal deficit is generally seen as a sign of a healthy economy. But achieving it often involves some tough decisions, like cutting spending or raising taxes. So, while it's a step in the right direction, it remains to be seen how it will impact various sectors and individuals. Section 5. Aiming high. 10.5% GDP growth. Still the goal. The government is setting its sights high, aiming for a nominal GDP growth of 10.5%. That's quite ambitious, especially considering the current global economic headwinds. But hey, a little ambition never hurt anyone, right? Achieving this growth will require a multi-pronged approach, including boosting investments, promoting exports, and creating a favorable business environment. It's a tall order, but not entirely impossible. After all, India has surprised the world with its remarkable economic resilience before. Section 6. Building for tomorrow. CapEx holds steady. Infrastructure is the backbone of any economy, and the Indian government seems to understand that. The capital expenditure target remains largely unchanged at 11.11 lakh crore. This means we can expect continued investments in roads, railways, ports, and other key infrastructure projects. These investments are not just about building concrete structures, they're about creating jobs, boosting economic activity, and improving the lives of millions of Indians. So, while the capex target might seem like a dry statistic, it represents a vital aspect of India's growth story. Section 7. Jobs, jobs, jobs. Internships and more. Job creation is a top priority for any government, and India is no exception. This budget includes several initiatives aimed at boosting employment, particularly for young people. One interesting program is a new internship scheme that will provide 5,000 rupees stipends. The government is also encouraging companies to utilize their corporate social responsibility (CSR) funds for skill development and job creation. While these initiatives are a step in the right direction, the real challenge lies in creating sustainable, high-quality jobs that can absorb India's vast workforce. Section 8. Gold gets cheaper. Duty down to 6%. Good news for all the gold lovers out there. The government has reduced the import duty on gold and silver from 15% to 6%. This means that buying gold in India just got a tad bit cheaper. Now, this move is likely to please consumers and boost demand for gold. But it might also have implications for the current account deficit, as lower import duties could lead to increased gold imports. It's a classic case of Economics 101. Every policy decision comes with its own set of trade-offs. Section 9. Capital gains. Holding on just got trickier. The budget also brought some changes to capital gains tax, and let's just say it has left some investors scratching their heads. The new regulations have introduced a level of complexity that many were not prepared for, and it's causing quite a stir in the financial community. The holding period for long-term capital gains, LTCG, for debt mutual funds has been removed, making it 12 months for listed securities and 24 months for other assets like gold and unlisted shares. This means that investors will need to be more strategic about their investment timelines, as the tax implications can vary significantly depending on the type of asset and the duration of the holding period. And the short-term capital gains tax, STCG, has been increased from 15% to 20%. This hike is expected to affect a large number of investors, particularly those who engage in frequent trading or have a portfolio that includes a mix of short-term and long-term investments. These changes are aimed at streamlining the capital gains tax structure and bringing it in line with other asset classes. The government believes that a more uniform tax structure will simplify the tax filing process and reduce the chances of tax evasion. However, the transition period is likely to be challenging for many. However, it remains to be seen how these changes will impact investor sentiment and the stock market in the long run. While some investors may adapt quickly, others might find the new rules daunting and reconsider their investment strategies. The true impact of these changes will only become clear over time, as the market adjusts and investors navigate the new landscape. Section 10. What's it all mean? Your wallet might notice. The Indian Budget 2024 has been unveiled, and it's packed with changes that could affect your finances in more ways than one. So there you have it, a whirlwind tour of the Indian Budget 2024. This budget is not just a collection of numbers, it's a roadmap for the country's economic future. From increased spending on infrastructure and healthcare to reduced borrowing aimed at stabilizing the economy, from job creation initiatives designed to boost employment to significant changes in capital gains tax that could affect your investments, this budget has it all. It's a comprehensive plan that touches various sectors and aims to drive growth. But the real question is, what does it all mean for you? How will these changes trickle down to your everyday life and financial well-being? Well, the impact of these budgetary measures will likely be felt across various aspects of the economy and our daily lives. From the cost of goods and services to the way we save and invest. Whether it's the price of gold, which could fluctuate based on new import duties, the returns on your investments, influenced by changes in tax policies and market conditions, or the availability of jobs driven by new government initiatives and funding, this budget is bound to leave its mark. It's a complex web of policies that will unfold over time. Only time will tell if it's a mark of progress or something else entirely. As we navigate these changes, staying informed and adaptable will be key to making the most of the opportunities and challenges ahead.